Good morning, everybody. Welcome to the Flow Show, Monday, 13th of January. I hope you're all doing fine and dandy and hope you all had a good weekend. Today, we welcome back Mr. K-Man. How's it going, sir?
Hey, good morning, Ryan. Morning, everybody. Happy New Year to those I have not wished yet. So there is, by the way, Happy New Year. Thank you. Yeah, I'm back. Well, at least for a short while, but yeah, I'm back, and it's been the start of the year. I mean, it's a lot of stuff is moving all around. I hope you're doing okay, Ryan.
Yeah, I'm doing fine, mate. I'm doing fine, trying to survive this first week. But yeah, I managed to get a couple of winners under my belt for the first week of the year, which I always like to do. First trades, just a little psychological thing I like to do. So yeah, managed to make a few pips last week. But yeah, bit of lots of stuff going on. We get this every year now. We get this first full week and a lot of positioning, a lot of money coming back on the table, and everyone getting set up for the next few months. And yeah, some wild moves indeed.
Coming back or taking off?
Yeah, either way.
Sterling, if you look at the sterling, it's rather taken off. But yeah,
Yeah.
yeah, it's been a pretty hectic week already, and more to come.
Yep. Yep. This is going to be the start of it. Yeah, very much more to come. Right, let's have a look at what's going on in the world, and then we'll get stuck into markets and whatnot. Firstly, a bit of data, and no surprise, we've been highlighting this for quite some time. What's been going on in China? Their trade balance ballooning by 22 billion, nearly 23 billion. Massive jump in exports, all down to this front running tariffs. Everyone shipping stuff out, getting stuff booked and on board and delivered before these supposed tariffs take effect. As you can see there, the dollar trade balance up at 100, nearly 105 billion, up from 97 previously. So these are some big numbers being posted here for that. We've also had the PBOC and China Safe, that's the Forex regulator. They've had a little old meeting talking about bits and pieces. They have done a bit of tinkering. They've raised the cross-border macro-prudential adjustment parameter. That's basically something that just allows, it's a ratio of how people can borrow across the borders, likely between Hong Kong and other jurisdictions like that. So they've raised that just to keep a bit of support in there. But more importantly, they've announced they will take comprehensive measures to stabilise market expectations, strengthen the foreign exchange market resilience, and strengthen foreign exchange market regulations. They say that financial authorities will resolutely correct the pro-cyclical market behaviours, resolutely punish behaviours that disrupt market order, and resolutely prevent the risk of foreign exchange rate overshooting. So this is probably the strongest set of comments we've had out from the PBOC and the regulator, the FX regulator, for quite some time. So they are still very much stepping up now their verbal intervention on the yuan. So that's good news for me. I'm staying short. Not that the yuan's actually gone anywhere any significantly after that noise. We're still up, knocking around these highs, but they're still keeping the brakes on. And as far as my shorts are concerned, the more talk like that, the better. But let's see if we do get a reaction in the exchange rate from that. They're still fixing in the 718s, by the way. They're not letting that go at all. Coming over to Europe, ECB chief economist Lane says there's probably more monetary easing to come, and that our baseline for Europe and the economy is one of a recovery. We shall see if that happens. ECB's Ren says it makes sense to continue with rate cuts. The direction of rates is clear and the growth outlook has weakened. Inflation is moving in the right direction. ECB's Wojcik says cutting faster would need a significant departure from our projections. We have seen the markets easing their expectations for ECB cuts. They now only see 3 25 pip cuts, or a total of 75 pips of cuts this year. Now, the ECB are in a bit of a similar boat to the Fed in terms of inflation. We've seen high readings out of Europe, as we saw last week. We've also seen high inflation expectations from the various surveys, be it the ECB survey last week or the Business Climate Survey, which saw consumer expectations for inflation rising again as well. The difference is the Fed are recognising this round of inflation and heading towards a pause. The ECB are ignoring it, and they say inflation will continue to come down and they're going to keep on the cut path. That's one reason why you are seeing what you're seeing in euro dollar, which cracked through 102 this morning. A big old level that is, although we're just turning around at the moment. So last week was all about traders repositioning and coming back into the market and so on and so forth. This week is getting right back into what the data is doing and what the central banks are going to be doing. And as I say, with the Fed heading towards a pause, maybe even market expectations for a hike will start coming in soon, but the ECB seem all intent to keep cutting. So that policy divergence is going to continue. That's what you need to focus on in the short term. Going over to last week's data and that bonanza NFP number, a real strong number all round. Pretty much everything was strong. Obviously, the headline 256 was very hot, nearly 100k above expectations. The unemployment rate came down strong. That was even while the participation rate stayed unchanged. Wages, that dipped a pip, but still remained strong. Month on month, still coming in as expected. So a very strong jobs number from the US there, which has had all the banks changing their forecasts, which I'll get to shortly, but it feeds into the pause narrative that we've got from the Fed. And as I say, at some point, if this keeps going, we will get some mechanical pricing for hikes, not real pricing in terms of anyone thinks they're going to start hiking, but those calls and those pricings will start at some point. Mark my words. Canada jobs as well, very strong. Nearly 100k, over 60k more than expected for that number. Very, very strong. Again, unemployment rate came down, was expected to go up. That was even while the participation rate stayed unchanged. So it was a good number. A lot of activity in full-time and part-time, but still strong in the full-time metric there as well. Michigan numbers, not too interested in the overall numbers, expectations, sentiment, etc. The big talking point was this jump in the inflation numbers, both up to 3.3%, both way above their prior numbers and what was expected. Again, this will play into the inflation picture for the US and the Fed. Expectations for higher prices can lead to higher prices. So this is the battle they're going to be playing and against right now. Kay, I don't know how much of this you saw, but just looking at it broadly, US facing pressures and it's still all guns blazing.
Yeah, exactly, and that's all part of the growth picture, right? It's very strong. We did see wages coming down a little bit, and I've also quickly read somewhere that the lower end of the job market with the lower pays are those who are seeing perhaps the lesser increase of their pays right now, which perhaps could mean something for the future. But I've also been thinking about this front loading, and we were talking especially about the Chinese exports. They're ramping higher on this front loading, front running potential tariffs, and I wonder if that employment number, those employment numbers in the States are not somewhere the same thing. They need to front run what could potentially come, the unknowns, and so therefore they need a lot of workforce right now to handle everything that they need to handle now, and then we may see those numbers change a bit. That's why I'm saying, like, and I went into this in our chat room as well. I've been talking about this potential Chinese revival, perhaps, but we need to wait. And I think again, these numbers, we need to be a little cautious, because imagine that Trump, and looking at the people that he gathered around him, starts to slap tariffs on the rest of the world. Those numbers could quickly reverse. So yeah, and I think so. For me, it's a bit early to call the Chinese revival, but they took advantage of those stronger numbers as well to come up with some pretty strong rhetoric. So that's probably encouraging as well for those who try to trade this, I would say, because they seem to show that they don't want to let things deteriorate any further. So that's one thing. And then on the US jobs, yeah, I mean, the data in the US are still defying the laws of gravity, right? And again, there, I mean, this is one that I was thinking about as well for 2025, and then the stronger those numbers are for the end of 2024, start of 2025, perhaps even January, will still print very strong numbers. But then afterwards, we will have to see really. That is somewhere where I am right now. But yeah, don't stand in front of the dollar wrecking ball, I would say in the meantime.
Yeah, absolutely. And I've been thinking this morning about the January numbers, NFP numbers, which obviously we get first week of February, and I don't know if December can be a bit of a funny time. Okay,
Mm.
we haven't seen to see any reaction from the storms that they had over there, but it's also that big retail month. We had a decent retail sales number in for November. So there can be the holiday hiring effect in there that drops out in January. That's a big risk. Obviously, this terrible stuff, wildfires going on in California, that might impact the jobs market somewhat, but that will be a known. So yeah, if we do get another strong one in January, then yeah, it's going to blow the doors off for Fed
Yeah.
expectations. But there is a risk that we do see a bit of a wobbly one, perhaps just because of those other factors that are in play at the moment.
I think if January, if we would see a setback of data in January, as a just a give back of the strong end of last year, I think then going forward, then it may be starting to get a little bit more risky. But of course, first of all, we need to see those numbers come out, and then we will think back about, well, what we were saying today, whether there is risk building in the United States or not.
Yeah, exactly. And that's what we're going to be trading for the early part from now on, and obviously still the Trump risk that we need to see when he sits in the hot seat later. Right. Anyway, moving on. Let's look at what's been happening regarding rate expectations. Right after all that data last week, we priced out a Fed cut until October. Okay, and that's pretty much disappeared this morning. So we've got very limited pricing for a cut this year. Barclays, they expected the Fed to deliver 2 rate cuts this year in March and June. Now they only see 1 in June. Goldies now see a total of 50 basis points of cuts versus 75 basis points for the year. And they expect those 50 pips to come in 2 clips of 25 at June and December meetings. JP Morgan also pushed their Fed rate cut forecast to June. They expected a cut in March. Bank of America was one who've gone a bit more extreme. They were expecting 50 basis points of cuts coming into this year. They now see none. So the cut cycle is over. And the risk of the next move is skewed towards a hike. Morgan Stanley, a bit of an outlier. They still expect the Fed to cut in March. Wells Fargo says a cut in March looks increasingly unlikely. And so, yeah, that's pretty much where we are with the market. Obviously, bank forecasts are what they are, not worth the paper they're written on usually, but everyone's getting very, very hawkish, hence why I think it won't be long if the data continues before we actually start to see some mechanical hike pricing. As far as the Fed heads go, Fed's Muslim says further rate cuts can wait, so he's willing to pause column. Fed's Goolsbee says we still should not over-index on an individual jobs report. I think he's been saying that for pretty much every data point that's come out for the last 6 months. So when do we over-index on reports? I don't know. Says we will have to monitor process on whether the retail gains were strong holiday season or something more general. Does not see the jobs market as a source of inflation. It seems stable and at full employment, and the current wage growth is consistent with 2% inflation given productivity levels. So all well and good there. Coming over to the UK, and last week we got some reports that we only had a week's supply of gas to get us through if we continue with the cold snap that we hit here. And now we've been told that, or from the UK government, that it's confident that there's enough gas and electricity capacity for winter. I'm still got my axe propped up against the door just in case I need to chop some trees down if energy supplies run out. Don't know what you're doing, Kay. Got any trees in your neck of the woods?
Oh yeah. I can. Since I moved not long ago, I still have a few to cut down if needed. So I'm good on that side for now.
Good stuff. Good stuff. Anyway, so let's have a quick look what's coming up. Sorry, that's into the headline. Don't know, Kay, if you've got anything you want to add to that?
No, that's fine, Ryan. Thank you.
Yeah. So let's have a quick look at what's going on. Not too much as usual after an NFP week, but we do have some key data points coming up tomorrow, and it's another one of these funky weeks where we actually get PPI before CPI. So the US, tomorrow we get PPI data coming out, which will be the appetizer for CPI on Wednesday. That is going to be a big number. CPI is expected to rise again, I think, to 2.9% from where it is at the moment. And have a quick look, so I know what I'm talking about. There we go. CPI 2.9 from 2.7. Core expected to come in unchanged at 3.3%. So market expecting higher numbers. If it's higher than expected, we're going to see the dollar go and bid more and probably yields rallying a bit more as well. But if it's a soft one, I don't think it's going to change thinking for a Fed outlook in the near term, particularly after all these banks have changed their forecasts. It'd have to be a real shocker of a soft number, I think, to change those meaningfully. We also get UK CPI on Wednesday as well, which no doubt will be a bit of a headache for the Bank of England and what they're going to be up to. They face a whole load of issues, what with this higher borrowing costs, putting pressure on the government and the government's fiscal space. So they're probably going to have one eye on that in terms of what they do with monetary policy. One way they could help the government, if they so wish, would be to potentially slow QT, leave a bit of liquidity in the market. So that's something to keep an eye on. They may not necessarily change policy in terms of interest rate, but they could do something on QT, if not by action, just by a bit of verbal. So that's something to watch out for. We also get the first manufacturing data of the new month, Empire State Manufacturing. It's not been that good an indicator. Well, pretty much going on a year, if not longer, but it is still the first number, so it could gain a bit of reaction in the market. Japan has a bit of PPI data as well to add to the inflation basket over there. Thursday, we're back on the jobs march with Aussie jobs data. Will it be a good one or will it be a weak one? We'll have to wait and see. Then we get some GDP data from the UK. This is monthly numbers. as well as industrial production and trade balance data. Now, something I sort of joked about this morning with UK trade is that the fall in the quid should be helping UK exports, unless there are no UK exports, and then it's helping nothing. But if we're going to see it anywhere, this fall in the quid over the last few months, we might see it in the trade balance data potentially. Thursday, we get retail sales from America and some further manufacturing data via the Philly Fed. So these retail sales will be pretty important. Add on to what we saw in November, just taking the whole period, November, December as a whole. So we had a strong November. Sometimes you can see a bit of a weaker December, depends when the splurge happened. But we'll have to say, take it all as a whole over the course of that 2-month period. Then on Friday, it's a bit of data out of China. We get some GDP data there, retail sales, industrial production, UK retail sales as well. That Eurozone HICP will be the final number for December. So we'll see if there's any revisions there. And then a bit of housing and industrial production from the US. Anything in particular, any other events tickling your fancy this week, Kate?
No, I think especially the inflation data, because it's what I said as well, and my thinking is that obviously there may be a bit of a battle of ideas starting to unfold, and especially if we think about on Trump's inauguration, potential tariffs and stuff. So people are wondering what's it going to mean for inflation data. So there may be a bit of a battle starting to unfold between growth and inflation. We've seen that the dollar is still better against most, and even if we look at the dollar yen coming back from those high 158s now down to 157, we're trading at 157. We're not trading at 150 or below, right? So I think there's going to be so even there the dollar is I'd say still relatively strong. There's going to be a bit of a battle, I think, of ideas between growth and inflation unfolding over the course of Q1, Q2, perhaps of this year, and so that's why I was arguing inflation wasn't really mattering too much for the end of the year, but I think it may come back now to the fore, because there is going to be this debate whether we trade inflation or growth differentials upcoming. So I do think that in those inflation prints will be kind of important now.
Yeah,
Speaking about that, and
yeah.
while you're on the yen, Ryan, am I right in saying that I saw Japanese data come out while I was out, which are really supportive of further rate hikes?
Yeah, we had some wage and income data that was pretty healthy looking.
Right.
There was a government up to its assessment for a couple of regions as well. So yeah, it's been going the same way, you know.
Yeah.
Not gangbusters, but just supportive.
Mm.
And yeah, we had another sources piece last week, getting hopes up.
Okay,
For the
because a lot of people
and
priced out any potential move this month, and but Bank of Japan is the first one of the, let's say, the big lot to decide what they do on the 24th, and maybe important, maybe a driver there for the yen, especially if you would get a number out of line with expectations on those US inflation data.
yeah, absolutely, and that's what some of that move we got last week as well, because we had a sources piece saying they're going to potentially up their inflation forecasts for fiscal year 24-25. It was the same as we got in December. You know, another sources piece hinting that they might do something in January, and yeah, we saw a reaction in the yen, but it got once bitten, twice shy last month, didn't it?
Yeah.
So I think it's going to take a bit more of a cautious approach this time around. But I did say also after the NFP, just be careful of this one, because although we saw, another lift in yields, it didn't really follow through, and neither did dollar yen. And this is probably the only dollar pair, although obviously we've got a lot of yen moves going on, that isn't following some of the others. But as you say, it hasn't gone too far. We've tapped 157. This isn't going to move too far while US yields are staying up. I keep saying that it's still probably a dip buyer's market. Just got to be careful of that volatility still, because that dip can be 100, 150 pips in a blink. But
Yeah,
157.
I'm just looking at the JGB yields. They are trading at their high. They are, so they have, and this is where what we always need to look at, because we look at US yields, but then also look a bit at the differentials and look at what the other side of the pair yields are doing, and Japanese yields are moving higher. So that is likely also something that has hampered the advance of the dollar yen. It's not everything, obviously, but if JGB yields are on the rise, that is definitely going to support the yen in some way.
Yeah. So bit of a balancing act going on now, whether it's going to react on the yen side to yen yields or react on the dollar side to dollar yields. For the moment, it's going to be leaning towards the dollar side. We're going to continue to lean towards the dollar side anyway. Right, so what's been going on? Well, as shown earlier, or as we've been talking about in the chat room, we've had a pretty decent looking break. There's a big level down here, 152. It's a 61.8 fib of the October or September 2022 move up to the 2023 high. So a big level, but it's also a big level on its own historically. So this is a real bit of a crunch time for the euro. We're turning around it at the moment. We had a dip to 101.78. And again, I think that was maybe just some morning action, just a bit of positioning. Obviously, there was going to be a ton of stops sitting through that 102. But we saw this move. I was actually posting about the 102 level being decent to support, and before I even hit the button, we were trading down to 101.78, breaking it. So look at this as a bit of a pivot area. I think if we can hold it from now, we may see a bit of a bounce coming from it. Don't ask me where that bounce goes, because they've been pretty weak since the latter part of the year and coming into this one. But if we're under there, there's really not an awful lot down until parity. And just something I want to highlight here from the longer term, I don't know if I can make it that clear. Let's go on to this chart. Actually, when you talk about parity, the 99 level is often a bigger level than the parity level. It's something we saw when we were down here last time. We broke through parity pretty easily, going back some time ago. But where we held up on the first test was down at that 99 area, not the parity level. So everyone will talk about parity, but I can tell you from history, the 99 level can be a bit more important than that one, at least on a first test type basis. So keep that in the back of your mind if you're thinking about catching knives in euro dollar, should we get a break from here. But I think, what happens now, if we get and hold back above this 102 into the US session, I think we've probably seen a bit of an overextension, maybe sort of that type of move. And then maybe we see a bit of a rally from there. But the levels keep stepping down. We were all talking about 106 latter part of last year as the resistance area. Then that stepped down to 105.30. Then it stepped down further, 104.5. Then it stepped down and it stepped down and it stepped down. Okay. So all these levels that you think, they're short term in the first instance, have turned out to be longer term levels that have held. So this is the near term one, 102.50s, 70s. Again, another historical zone that goes back many, many years. We're finding resistance into that at the moment. So that's your first step in turning around just this part of the move here. But you're going to need to stay above 102 in the first instance to do that. What are you making of the euro here? I mean, both you and I have been bearish on it for for a while. Didn't really get any sort of end of year real lift to park into some shorts.
No,
But
no,
you
that's
don't want
true,
to chase it down here, do you?
yeah, that's true, and also that joins the Marianne question. What would you like to see before buying euro dollar? Well, there's two things, Marianne. There's always two sides to a currency pair, right? So what would be um, a real good thing to underpin the euro dollar, I think, in this instance, is if European growth starts to pick up again. And I would say that growth is not for Europe. Inflation is sticky, like in the rest of the world. And the risk is that it ticks up if Trump slaps tariffs on Europe. So I don't think that is going to be a factor that underpins the euro dollar. But what would for sure underpin it is European growth coming back. And then I'm especially thinking about the two engines, which are France and Germany, but also like other core countries like Holland, for instance, or Italy, Spain has been a little bit of an outlier, doing better than the rest. But yeah, it would for sure be growth in the eurozone. And then the other reason for buying euro dollar, and I mean for a lasting move, right? Not for the intraday, goes down to 101.80 and you buy it for 102.10. That's not like really buying euro dollar, right? That is just playing a bit of a bounce. I think the other reason is that if Trump really goes softer than what the market expects, if to say it bluntly, Musk shuts up a little bit, perhaps, and if some of the hawks, because as we've been saying, Trump has surrounded himself with very hawkish people, actually. But if they would go softer, I think that would potentially create a bit of a turnaround. And then the third thing is data. I mean, for now, it's very hard to buy euro dollar if you look at the data in the US, because they are as we've been saying a lot of times, they are really not coming off more than just givebacks, temporary givebacks. We have seen that mid year last year, where it was seeming that the employment market was cooling down a little bit, but it was just a temporary little blip, and then they came back. So you need to see some factors where, as Ali says, like the fundamentals are shifting, whether it is on the one side or the other side of the ocean. And I would say really you need both, but I would already say perhaps a European revival might be even more important than a US slowdown in this case. But I think both may be we may actually see a complicated combination of both over 2025.
Yeah, I can agree with that. And there's one distinction you have to make between the US and Europe, particularly regarding inflation. Okay, everyone got caught with the same inflation cold when it all went rocketing up, and everyone had to react the same way. This time, or where we are now, is completely different. The Fed have a strong economy and a tick up in inflation. Now, when you've got a strong economy, you naturally get some inflation with it because people are confident in putting up prices. People are confident in going for higher paid jobs and offering wages and that sort of thing. When you have an economy like Europe that's much weaker, it leads to bigger price pressures. Firms not seeing any activity, the natural thing is to cut prices. So there's more chance of Europe seeing inflation coming down, thus keeping on their cut path, than there is in the US. So even if the US doesn't improve, or its economy just pulls back a bit, inflation comes down a little bit, it's still going to be more sticky than Europe. Okay, so that's still going to keep the dollar on the bid side, and then on the ECB side, the European side, if inflation is coming down, the economy is doing weaker, then they're going to get in a bit of a pickle. They're going to cut rates much faster. Okay, so euro dollar is still going to be potentially heading lower. But as Kay says, it needs a revival in Europe, but it needs a big revival. I mean, we're not talking about growth going from 0.1 to 0.5. That won't cut it. Okay, so unless there is a big revival, a really strong revival, then I don't think this weighing scales that we've got at the moment favouring the US side of things is going to change. So yeah, even with a European revival, that might be euro dollar back up to 105 or something before it runs out of legs. But that's just a fag packet estimation for that. But yeah, I think I'm still in the same boat. I still favour worse to come for the euro side of things. When talking about euro dollar, I still think they're going to be cutting rates further than they expect or will want, and that's going to keep euro dollar under pressure. I don't know if you've got any different thoughts of that.
Yeah, the thing is, it's comparable to in the fact of trading it. There are of course different economies and different components in China and Europe, but it's a bit the same. You need a revival locally. You need a revival of China to get the dollar China lower. You need a revival of the eurozone to materially and lastingly put a bit under the euro. And as Ryan was saying, maybe we can bounce 105, 6, 7 even. But if we are to really start to buy euro and have a chance to get back up to 111, 112, or who knows, even higher, yeah, it's going to need something serious in the eurozone to spark such a move. Now, in the meantime, it's probably going to be the case. Now we are seeing this buying spree in the dollar, selling euro, selling sterling, and whatnot. We are going to see hiccups, I think, but depending on what's happening in the US. And for now, I think the risk of the US slowing down the line is perhaps a little bigger than the euro seeing a big revival right now, because I really don't see what's going to turn Europe around right here and now.
Yeah, I mean, there's one outlier way that euro balloons higher, and that's if the Ukraine Russia stuff comes to a conclusion. Then we'll see a real big risk rally, and that'll be good for Europe because it means they won't be pouring billions and billions continuously into Ukraine, which means they can spend it elsewhere. But I think the market will just take that as a big risk on type trade, and close proximity to Europe will probably benefit from that. So that will be one outlier reason why you might see euro dollar, back up at 110 or something like that. Something stupid, yep. But that will happen if it happens, and we have to trade what it does in the meantime. Kay, do you want me to keep looking, or have you got anything you want to pick out particularly?
Well, you can just put up the Swiss, or I can actually I just have like if you want I can show gold, silver, Swiss, perhaps oil. If you want to show anything else, I'm only going to show those because those are really on my radar somewhere now.
Yeah, let me hang on. Let me hand it over to you. Yeah, just have a look at a couple. It's Monday, so
sure.
Doesn't matter if we're not looking at too much. Right, all yours, mate.
Okay, here we go. So just to answer Ali's question right now, I don't think, Ali, that there is any reason for S&P to be supportive unless they are looking at the same picture than we are, but they probably won't and say like, oh, okay, Euro Swiss is coming down a bit. We need to support it here. I do not think so. There is no reason for them to really start panicking. If you look at SMB supporting stuff, it's probably going to be much lower, somewhere mid 92s in the Euro Swiss. And they also know that if you get a weak patch in the euro, S&B, they know they are financially erudite enough to go and say that we cannot support this whole thing on our own. So I don't think that that you need to be worried about S&B also. Trading the ranges, yeah, well, it should hold here, 40-50 on the Euro Swiss, very short term. It should hold here. If not, I think there is a risk to get back down to low 93s on the Euro Swiss. So this is the first look that I have at Swissy for a while. On the other side, if you look at the dollar Swiss, and this is the daily, we are getting closer to after this really pretty sharp bounce that we saw in the past months. We are getting closer to pretty decent levels here, 92, 92 and a half. Keep a close eye on those. It's your high from September 2023, high from 1st of May 2024, and we are getting closer to pretty important levels here on the dollar Swiss, in my opinion. Also halfway of the big decline that we saw unfolding from 2022 into the end of 2023 that we recall was really like a big positive Swiss move. So I think keep an eye on that 92 and a quarter, 92 and a half on the dollar Swiss. All right. And then yeah, we need to look at oil. It had this spike on those extra sanctions, but hearing this morning already that OPEC may plan to fill the gap if there's a gap in Russian oil. So we just tagged that 78 and a half ish, where we saw the spike up in October, and we're shying away. I mean, either you look at this, the break, and that's around where we trade right now, or you look at the other one here. But those are two pretty important levels, and I would argue if we get back below 77, which is roughly what we are. Oh no, this is what is this? Why am I here? Why is this trading 78 where I see 77 on WTI? Perhaps the one is the CFD and the other one is the spot. Okay, I must anyway, on my picture here, it's going to be 78 and a half and 77. I think I may be looking at something different here. Okay, I'm going to have to look at exactly what I'm looking at. But anyway, on this picture, it's a pretty important level here. And then traditionally, gold and silver. Look at gold. It's you know what my idea, right? That gold was still going to be one of the trades of 2025 potentially, depending on how hard Trump goes into the tariffs. We trying to break out of this of the triangle, which would be extremely bullish in my opinion, because if you look at the longer term, this would be really getting out of a bullish consolidation triangle and start to go back up. But it's still early days this year, so I've decided to take a little bit off of my longs and see what's going on here. So 2680, we are trading right around it right now. It's a bit of an important one. Okay, if we start to confirm above that 90.95 again, I think we can potentially go and have a move higher. Again, it's pretty strong to start the year, and that means that I'm not alone in my thinking that despite higher rates, this could be a protective trade in 2025. I'm much less impressed with what's happening in silver right now. We saw the bounce. Yes, it is bouncing. Yes, we got back above that zone, but I think this zone now is really starting to get watered down. I'm much less impressed because the reason why I'm saying that is that I'm not sure about what's going to happen with growth, because if we really go onto a very big tariff input in the market, this is not going to go well for growth. And then I would say that silver is at risk of really continuing to underperform gold for quite a while. So on this one, I'm still really very cautious. It is rebounding, yes, but we are going to have to hold levels and get back up even above 31 really to be out of the danger zone and start to move higher again. So that's about my findings coming in. I trust you spoke a lot about sterling and cable already, Ryan. We are on the approach of relatively important levels here. 120, 120 and a half. I think on the cable is a pretty important one. If we get below 120, psychologically, it could really hurt the sterling more. It looks like the risks that we were talking about, that at the start of 2025, the loss in faith of what the government can do, the finances, what the Bank of England can do about it, is that's a risk, and really sterling is undergoing this risk right now. Back over to you, mate.
Yeah, thank you very much, mate. Yeah, I'm concur with that. Been saying 121 down to 120 is my area for cable, where it's probably about the only place I would maybe try to catch a knife, depending on why we get there. But yeah, it's not looking too hopeful at the moment. Well, we've already had a test of 121 already, 121.02 for the bounce, so it's already started. Right, we'll call that a day for today, just to get us up to speed for the week ahead. So as always, thank you for coming to the Flow Show, and have a great week, and we'll see you all tomorrow. Have a good one.